Welcome to the Deep Dive. When the market moves, we make sure you know exactly why.
That's the goal.
Today we're unpacking the Q3 2025 earnings call for Accel Entertainment. This one wrapped up after hours, November 4th. And the immediate reaction, well, it was constructive. Stock bumped up just over 2% the next day.
Yeah, that plus 2.1%. I mean, it might sound small on the surface, but, given the broader market, it really signals something.
Right, not just noise.
No, exactly. It felt like the market actually liked the direction, like the details management laid out. Not just relief, more like an endorsement of, how they're executing.
That's a good way to put it. So our mission today, as always, is to cut through the call transcript and pull out the key strategic points. We're really focusing on what those headline numbers tell us about their local scale strategy, how stable those core markets are looking.
And maybe most importantly, how they're positioning that a newly cleaned up balance sheet for what comes next, growth, M&A, that kind of thing.
Exactly. So let's start where the market started. Those headline numbers that seem to drive that positive initial feeling.
Okay. So total revenue landed at $329.7 million.
329.7. And how did that compare?
That was a clear beat over consensus. Expectations were hovering around $328.0 million.
Okay, so a nice beat there.
And, crucially, this was solid year-over-year growth, 9.1%. Pretty robust.
And importantly, that growth didn't seem to come at the cost of profitability, which you sometimes see with expansion pushes.
No, you're right. Adjusted EBITDA, it actually grew even faster, up 11.5% year over year, came in at $51.2 million.
Wow, 11.5%.
Yeah, that really demonstrates excellent operating leverage. It shows, as that footprint gets bigger, they're keeping a really tight grip on costs. So the top line growth is flowing through nicely to the bottom line.
Okay, now the net income number. That will look huge at first glance, a massive jump, 171.8% to $13.3 million. Before anyone gets too carried away with triple-digit growth, what's the story behind that number?
Right, and that's exactly where you need to dig in a bit. That 171% jump, while it looks great, it was significantly boosted by a one-off item, a $2.2 million gain related to a fair value change of an earnout.
Ah, okay, so not purely operational.
Exactly. Impressive on paper, but you can't chalk all of that up to just core business improvement.
And I guess that ties directly into the difference between the reported GAAP earnings per share and the adjusted number, which the street always seems to focus on.
Correct. The GAAP diluted EPS was $0.16, but the number everyone was watching, the adjusted EPS, that printed at $0.24.
24 cents. And consensus was?
Consensus was $0.20, so a solid 4-cent beat there.
Okay.
And really, that adjusted beat, you combine it with the slight revenue upside, well, that gave investors the green light they needed, basically. It pushed the stock a bit higher. They hit the targets where it really counted operational earnings.
Makes sense. Yeah. Okay, let's move beyond just the headline figures and look at the engine driving them. It feels like they're running a bit of a dual strategy, right? Like optimizing the core versus really scaling up in the newer developing markets.
That dual approach is absolutely the heart of the Accel story right now. Their total footprint, it did expand up to 4,451 locations.
Okay.
That's up 3.8% year over year. And terminals were up too, 27,714, which is about 4.5%.
Right.
But like you said, you have to look at where that growth or lack of pure growth is happening.
Because those core markets, Illinois and Montana, making up, 82% of revenue? It's not just about adding more locations there anymore, is it?
Precisely. In Illinois, especially, management was very clear. The strategy now is optimization. Full stop.
Right.
Meaning they're actively closing down older underperforming locations and simultaneously opening new ones that perform significantly better right out of the gate. So the result is the actual machine count might stay relatively flat, maybe even dip slightly sometimes. But the key metric, the average revenue per machine, that keeps ticking upwards. They're basically squeezing more yield out of that mature, highly regulated Illinois market.
Okay, maximizing yield in the core.
Yeah.
But the real excitement, the growth spurt, seems to be coming from that developing portfolio.
Absolutely. The acceleration there is, it's pretty staggering, actually. Nebraska revenue grew 30%.
30%, okay.
And Georgia revenue surged by almost 50%, 49.3% to be exact. Management specifically flagged those two as the highest quarterly growers.
Wait, hang on. 49.3% in Georgia. That's fantastic, obviously. But playing devil's advocate here, is that just a low base effect kicking in, or is there something genuinely sustainable about that kind of growth rate looking into 2026?
That's a fair question. And management kind of framed it as, look, we're still penetrating these underserved regions. So yes, the base is smaller than Illinois, but the consistency of the sequential growth quarter after quarter, it suggests they really are executing that local scale strategy successfully. Acquiring routes, plugging them into their system, driving operational improvements quickly.
So it validates the playbook, isn't
Exactly.
it?
It shows they can replicate what they perfected back in Illinois, just in new geographies.
We should probably mention the one slightly sour note in the state-by-state breakdown, which was Nevada. Saw a bit of a decline there.
Yeah, Nevada was down 7.4% revenue-wise, but management was explicit about that one.
Okay.
They tied it directly to the known loss of a key customer back in 2024. Change of ownership, I think. The key point is it seems like a one-off event, something that they'll help anniversary soon. It doesn't look like a sign of some core operational problem in Nevada itself.
Got it. Okay, shifting focus slightly to the brand new scale-up efforts. Louisiana seems to be ramping up pretty quickly in importance.
It is, yeah. Even though it's still only about, 3% of total revenue so far. But following that Toucan Gaming acquisition they integrated,
Right.
they're now at 670 terminals across nearly 100 locations there. It really shows their commitment to using those smaller bolt-on M&A deals to strategically grab market share outside the core states.
And we also got the first full quarter of results from the Fairmount Park Racino, the casino and racing facility that opened back in April 2025. How's the early contribution looking there?
Initial signs are highly encouraging, according to management. They specifically mentioned seeing sequential monthly gaming revenue increases through the quarter.
Okay, good momentum.
Yeah. And they also confirmed positive early contributions from that FanDuel sports betting partnership. Seems like customer engagement is building as they kind of fine-tune the place and the whole customer experience. It gives them another significant lever, outside their traditional distributed gaming business.
Okay, so lots of moving parts on the growth side. Now, let's talk about something that sounds maybe a bit dry, but could be huge for margins long term. Operational throughput and this ticket in, ticket out, or TIDO functionality. We know they're rolling it out. But why should you, the listener, really care about TIDO financially? And what's the actual timeline on seeing the benefit?
Right. TI2 is potentially a huge operational lever because basically it shifts the whole operation away from handling physical cash towards using digital tickets.
Okay.
So for Accel, this means, lower labor costs eventually, less time spent collecting cash, reconciling it, securing it, all that stuff.
Okay.
But maybe more importantly, it improves cash velocity. Money just moves faster electronically, gets back onto their balance sheet quicker. That's the real financial kicker long term.
So if it's so great, why isn't it boosting margins right now?
Because the rollout is still really early days. Management was very upfront about this. They noted TI2 utilization is currently only in the mid-single digits, 4 or 5% maybe.
Oh, okay. Very early then.
Very early. And they were pretty transparent, saying, look, the material effects on performance, on overall cash balances, you probably won't see those until well into the second quarter of 2026.
Okay. So that's a clear flag for investors then. TITO is a story for mid next year, not an immediate Q4 or Q1 catalyst.
Exactly. Manage expectations on that one.
All right, let's pivot then to capital discipline, because they made some pretty strategic moves this quarter, didn't they? Setting themselves up for the next cycle.
They did. Executed a really smart refinancing, actually. Completed a new $900 million senior secured credit facility. It's a mix of a term loan and a revolver.
And the key benefits.
Well, it pushes their debt maturities way out, all the way to 2030. That gives them a lot more breathing room. It enhances their liquidity position significantly. And crucially, in this environment, it actually lowered their overall cost of capital.
Nice. So they ended the quarter with quite a bit of cash on hand, right? $290.2 million against net debt of about $305 million. Sounds great on the surface, but management made a specific point about why they need so much cash sitting there.
Yes, and this is really crucial if you're trying to model their actual available liquidity. While that cash balance looks high, a pretty significant chunk of it, we're talking tens of millions, is essentially tied up operationally.
How so?
It's needed to physically load their redemption terminals, the machines that pay out winnings. Especially in their big cash-heavy routes like Illinois, they need that cash readily available to make sure customers get paid out instantly.
Right. Can't have those running empty.
Exactly. So while they definitely have dry powder, some of that headline cash number isn't truly discretionary for M&A or buybacks.
Okay, good context.
They also kept their full year 2025 CapEx guidance steady, $75 to $80 million. And about 40% of that is specifically earmarked for growth stuff, Fairmount, other new market expansions.
Okay, so they've got better terms on their debt, improved liquidity, even accounting for that locked up cash. How does this translate into their M&A strategy moving forward?
They pretty much reiterated a highly disciplined approach. They know the market they play in local gaming is huge. They estimate it at $15 billion nationally, and it's super fragmented.
Lots of potential targets.
Tons. But management confirmed they're staying patient on any really big transformational M&A deals. Why? Because they're seeing public gaming multiples starting to compress a bit.
Meaning potential targets might get cheaper.
Exactly. They think waiting might yield better prices down the road. So patience on the big stuff.
But still active on the smaller sort of bolt-on growth opportunities.
Precisely. Their immediate M&A focus is definitely on those bolt-on deals. Specifically mentioned Louisiana, especially truck stops there, and also some select opportunities back in Illinois.
Places where they can plug acquisitions right into their existing machine.
Right. They feel they have the operational chops and the financial headroom now to absorb those kinds of additions quickly without really stressing the balance sheet. They did note that seller expectations haven't fully caught up to the lower public multiples yet.
The classic bid-ask spread.
Yeah, but they sounded hopeful that the direction of travel suggests maybe better deal flow, better pricing heading into next year.
Okay, speaking of next year, they didn't give formal number guidance for FY 2026, did they? But what were the sort of non-financial themes or catalysts we should be watching?
No hard numbers, no. The guidance themes were more around, continued location expansion overall, successfully scaling up Louisiana, and really maximizing the performance out of that Fairmount Racino.
And externally?
The big external catalyst is always legislative change in this space. Accel is keeping a very close eye on potential new VGT markets opening up. Pennsylvania, Missouri, North Carolina, Virginia were mentioned. And they also see potential for ongoing sort of favorable tweaks to regulations in states they're already in, like Georgia, Louisiana, Nebraska. Little changes that could actually materially help operators in the near term.
So boiling it down, the near-term catalysts seem to be adding more units in Louisiana, getting the seasonal lift at the Racino, and maybe more share buybacks.
Right. They did buy back $6.8 million worth of stock in Q3. And with those better terms on the new credit facility, they certainly have the financial flexibility now to be potentially more aggressive on returning capital to shareholders if they choose.
Okay, now it is time for our favorite segment, the part where we absolutely have to remind you, this is not financial advice. Right. We are simply taking all the data we just talked about, putting on our hypothetical portfolio manager hats, and constructing a highly aggressive, maybe outrageous but plausible trade idea, pitching it right now to our imaginary investment committee.
All right, let's do it. The premise for this trade idea really stems from that disconnect we kind of talked about earlier. You've got Accel, who looks maybe a bit under-levered compared to some peers. Okay.
They just locked in cheaper debt with that refinance. They signaled they're going to be patient on big M&A deals, and yet the stock only popped about 2%. Kind of a muted reaction.
Suggesting the market isn't quite sure what they're going to do with all that operational cash flow and flexibility right away.
Exactly. There's some uncertainty about immediate capital deployment.
So how do we, in this hypothetical scenario, force the issue? Force that deployment and maybe create some immediate shareholder value?
We propose a leveraged pre-M&A accelerated share repurchase, an ASR.
Okay, an ASR. For listeners maybe not familiar, how does that differ from just a regular open market buyback program?
Yeah, good question. So an ASR is basically a contract. The company pays an investment bank a big chunk of money up front. In return, the bank immediately delivers a large block of shares to the company, effectively shrinking the share count right away.
Faster, more impactful than buying back slowly over months.
Much faster, much more aggressive, gets a lot of shares off the market quickly.
Okay, walk us through the mechanics of this proposed play. All right, action. Immediately draw down an extra, say, $100 million to $150 million from that new cheaper $300 million revolving credit facility they just put in place.
Use the cheap debt.
Use the cheap debt. Take that cash and execute this highly time-constrained ASR now. Lock it in. Leverage the current stock price, which we feel didn't fully react, to maximize that short-term reduction in the share count, the float.
Okay, but why the urgency? Why do it now instead of waiting?
Because the idea is to capture the financial benefit of this move before the market fully prices in two things we know are coming down the pike.
Which are?
One, the strong underlying growth that's clearly happening in Georgia and Nebraska, which might take another quarter or two to be fully appreciated. And two, crucially, those longer-term margin benefits from the TI tow rollout, which management themselves said won't really hit the numbers until mid-2026.
So front-run the good news realization.
Kind of. This ASR is immediately accretive to earnings per share because you're reducing the share count. It signals huge confidence to shareholders right now. And importantly, it deploys capital efficiently today without really compromising the bigger pile of dry powder they still need for potential transformational M&A next year or the year after.
So shareholders get the benefit of a current operational strength now before any M&A execution risk potentially muddies the waters later.
That's the rationale. Capture the efficiency gains now, worry about M&A integration later.
That is certainly a clean, leveraged pitch based on the quarter's data. Okay, to wrap things up, Accel delivered what feels like pretty resilient performance. They're leveraging their scale effectively through that dual strategy optimization plus new market growth, and they very skillfully cleaned up their balance sheet, giving them a lot more strategic optionality going forward.
Yeah, solid quarter overall. But here's the final provocative thought for you, the listener, to maybe chew on. Management was crystal clear that the strategy in Illinois, right, their biggest, most important market, is now all about yield. Getting more dollars per machine, not just more machines.
Right.
So the question becomes, given the regulatory environment there, the caps on locations, how much runway is actually left for that yield strategy in Illinois? At what point does market saturation or maybe regulatory ceilings force Accel to really pivot, to shift their capital allocation almost entirely away from Illinois and towards the newer places like Louisiana or those states they're watching like Pennsylvania or Missouri? That pivot point, that feels like the really big strategic question for shareholders as we head into 2026 and beyond.
When does optimization hit its limit? Definitely something to mull over. Thank you for joining us for this deep dive into Accel Entertainment's Q3 2025 earnings. We'll catch you next time.